Welcome to this explainer. Today, we're tracking what I can only describe as a slow-motion disaster. We're going to explore exactly how a highly localized problem, specifically a slump in the United States housing market, somehow managed to trigger an absolutely catastrophic, near-total global financial collapse. It's a crazy story of deep interconnectivity, where a tiny ripple on Wall Street literally turned into a tidal wave around the entire world.
So right off the bat, you might be wondering about this staggering central question. How does a single economic sector in just one country manage to completely unravel the global order? I mean, we're talking about bankrupting legendary institutions, freezing international credit, and ultimately driving 50 million people on the complete opposite side of the planet into poverty. There's really no way to overstate the scale of this.
Okay, let's dive into this micro to macro journey. For our agenda today, we're hitting 5 key beats. 1. The subprime spark. 2. The financial meltdown. 3. Global bailouts. 4. Main Street's pain. And 5. The fragile state whiplash.
All right, kicking things off with Section 1, the subprime spark, the initial cracks. To really grasp this collapse, we have to go back to early 2007. We're basing our timeline today on some incredibly meticulous work compiled by the Lauder Institute. They tracked this whole thing day by day, mapping out exactly how early warning signs were basically just brushed off, only to eventually cascade into an unstoppable force.
So what was the actual epicenter of all this chaos? Well, it was the subprime mortgage. Basically, these were super high-risk home loans given to borrowers in the U.S. who, frankly, often just didn't have the means to pay them back. When interest rates shifted and housing prices stalled out, these borrowers started defaulting in massive numbers. And here's the catch. Because these risky mortgages have been bundled up into giant packages and sold to hedge funds and major banks all over the world, those localized defaults turn into quiet losses spreading through the entire global financial system.
The initial panic unfolded so fast. By February 2007, you have HSBC announcing major losses linked to these subprime mortgages. A couple of months later in April, New Century, a huge subprime lender, files for bankruptcy. By June, massive Wall Street players like Bear Stearns are frantically dumping assets. And then by September, the panic officially crosses the Atlantic. Depositors actually withdrew £1 billion from Northern Rock, which was the biggest run on a British bank in over a century.
That brings us to Section 2, financial meltdown, the system freezes. Because honestly, those early warnings, they were just the tremors. The fundamental mechanism of this total collapse was what experts call an evaporation of liquidity. Let's think of the global banking system like a massive engine. In this analogy, trust is the oil that keeps everything running, right? Banks usually lend cash back and forth to each other constantly. But suddenly, nobody knew who was holding on to those toxic, worthless subprime mortgages. Trust just completely vanished. Banks flat out refused to lend to each other because they couldn't even value their own assets, let alone anyone else's. The cash flow literally froze. And this freeze, it led to some of the most frantic, heart-pounding weeks in modern financial history. Legendary titans were falling like dominoes. September 7th, mortgage giants Fannie Mae and Freddie Mac have to be rescued. September 14th, Lehman Brothers actually files for bankruptcy. The very next day, Merrill Lynch is forced into a sale. And the day after that, the U.S. government has to step in to bail out the insurance behemoth AIG. It was absolute chaos.
Now, to put this all into perspective, we have to talk about this staggering number, $639 billion. That was the value of the Lehman Brothers bankruptcy. To this day, it remains the largest bankruptcy filing in United States history. When Lehman was allowed to fail, it shattered whatever tiny bit of fragile confidence was left in the market. The shockwaves completely paralyzed global markets.
Which leads perfectly into Section 3, global bailouts, the scramble to save. With the engine totally seized up, governments had to act fast.
Governments basically had to drop lifeboats into a rapidly sinking economy. We saw these incredibly desperate, coordinated actions by world leaders. October 3rd, the U.S. passes a massive bailout. Days later, the UK announces a £500 billion bank rescue package. By mid-October, the U.S. rolled out another plan to literally buy stakes in banks just to keep their doors open. Meanwhile, central banks all over the globe are slashing interest rates in these unprecedented, coordinated cuts, just desperately trying to restart the flow of money.
The price tag of that initial U.S. asset relief bailout was an almost unfathomable $700 billion. And what's really wild is that Congress actually voted this down at first. That rejection caused the stock market to experience its biggest point drop ever up to that time. Lawmakers quickly reversed course and passed the rescue plan. But think about it. This was taxpayer money being pumped directly into failing private institutions just to prevent total societal collapse.
And in this stunning twist of irony, we have Alan Greenspan, the former chairman of the Federal Reserve, and historically a huge proponent of a totally hands-off, deregulated banking industry. He actually admitted before Congress that the credit crunch had left him in a state of shocked disbelief. I mean, the very architects of the system were stunned by its fragility. He essentially had to acknowledge that his entire approach had been partially wrong.
Moving on to Section 4, Main Street's pain, real economy freezes. Because the real tragedy here is that this disaster absolutely did not stay contained to Wall Street.
The banking freeze battered everyday life with undeniable force. Stock markets completely plummeted, wiping out people's pensions and life savings. As I mentioned, the Dow Jones dropped 777 points in a single day when that bailout initially failed. Entire nations plunged into deep recessions almost overnight. The UK economy, for example, shrank by a dramatic 1.5% in just one single quarter.
The credit crunch hit everyday workers so incredibly hard. By November 2008, U.S. employers were shedding over 500,000 jobs in a single month. 500,000! The big three automakers in the U.S. were practically begging for rescue funds to avoid total collapse. Global consumer confidence hit absolute record lows. Over in Iceland, the economic strain was so devastating that their entire coalition government literally collapsed. Main Street was paying the ultimate crushing price for Wall Street's toxic mortgages.
Which brings us to our final part, Section 5, Fragile State Whiplash Global Shockwaves. Zooming all the way out and looking at some brilliant analysis by the Brookings Institution, we can see how this tidal wave hit the furthest, most vulnerable shores. You see, the poorest nations weren't really dealing with complex derivatives or subprime mortgages. They were hit by what Brookings calls the whiplash effect. In early 2008, the prices of basic commodities, we're talking oil, aluminum, corn, they spiked completely off the charts. But then, as the global recession really took hold in late 2008, those prices nosedived. This violent, massive swing completely decimated fragile states that relied on either selling or buying these basic goods.
And all of this builds up to a truly tragic human toll. The World Bank predicted that the fallout from this global economic whiplash would push 50 million people globally into poverty. 50 million lives completely upended, and they were entirely detached from the fancy boardrooms where these financial instruments were even created in the first place.
What's fascinating, though, is how wildly uneven the impacts were. It was purely based on whether a country bought or sold those commodities. Exporters like Nigeria and Equatorial Guinea, who were loving life and enjoying huge revenues when oil was high, suddenly faced massive budget shortfalls and huge income drops when the market crashed. But conversely, importers like Pakistan actually gained this bizarre temporary reprieve. Because crude oil prices dropped so dramatically, their purchasing power suddenly went up, which essentially saved them from immediate economic ruin.
And we have to remember, this isn't just about spreadsheets and numbers, it's about physical safety. Economist Paul Collier hit the nail on the head when he pointed out that in fragile states, a shrinking economy is a direct recipe for war. He noted that every 1% drop in economic growth raises the risk of conflict by 1%. Financial instability rapidly breeds serious political turmoil. So the 2008 crisis literally reshuffled global geopolitics. Unstable, oil-dependent exporters like Nigeria risked spreading regional contagion as their revenues just vanished into thin air. Meanwhile, countries that are critical to global strategy, like Pakistan, gained unexpected stability. Even in places like Iran, falling oil revenues meant less cash for the government, which led to simmering domestic discontent and actually created a higher likelihood of opening up international dialogue. The U.S. housing slump essentially redrew the entire geopolitical map.
Which leaves us with this final, absolutely vital question to chew on. We've just seen how a localized issue in American suburbs froze the global banking system, caused trillions of dollars in bailouts, cost millions of jobs, and whiplashed the poorest nations on Earth. In our intimately connected modern world, the ripple effect is absolute. So, taking all this in, if a housing slump can do all of this, are we truly prepared for the next economic shock? Thank you so much for exploring this with me today.